Today's number is 3 because what we are witnessing in this market has never happened before. Over the last 24 hours, one company just applied for 59 triple leveraged exchange traded funds, and it's giving liquidity and leverage to people that maybe shouldn't have it. So, what exactly is in store next? Could this be a sign of euphoria and the peak? Well, one thing's for sure, the US dollar is doing something strange, and at the same time, it's debasing against so many precious metals. Could this be the beginning of the end? And in our last video, we talked about abundance on palladium and other investment assets, and look how far they can go. Could this just be the beginning? Stocks, commodities, and cryptos? Guys, there's a lot of opportunity out there. Let's take a look right now together at what you need to know coming into this earnings season. See you in a moment. Well, welcome back everybody to The Daily Show. My name's Thomas Atkinson, and in today's video, we'll discuss the macro, the data, the dark pool trades, and of course, the leverage that seems to be coming into these markets. Don't go anywhere because there are quite a few big stats that I think you'll find very interesting. On top of all of that, we saw semiconductors rise up again over the last 24 hours, and we've seen a bit of a change in markets, and that is towards the idea that everybody is now getting in on it. Why do we know this? Well, T-Rex just filed for 59 new triple leveraged ETFs. And by the way, they're all longs. Take a look at some of the names here. And these are coming as soon as supposedly the 22nd of December. Now you might think, well, what's the big deal? Well, of course, people don't necessarily need to get checks to get access to this leverage. And it's just part of the bigger underlying problem that is happening right now, with more retail traders coming in by the day. And in fact, according to Marlin Capital here and Morgan Stanley, we've just seen the largest inflow ever recorded from retail traders. Now, retail's been ahead of the curve this year in terms of buying the dip, and this is something that happened similarly in 2020, as you can see over here. But could it be time for a little bit of Wall Street shenanigans, where they basically rip from retail traders all of the leverage and hit some stop losses? Well, according to Goldman Sachs' latest data that we shared in the previous video, we found something similar to this. A market that is all about stock picking. It's not so much the index anymore that matters, it's which particular stock are you in. Are you in particularly some semiconductors or other things that are finding the strength? Because the correlation right now is completely different to what you'd usually expect in a high breadth market, with only 0.08. Now, what that's telling us, guys, is that if you've been in semiconductors or Magnificent Seven stocks or hyper growth scalers, that you've done very well. Also, of course, metals, which we've been talking about all year on this channel. But if you've been in the wrong sectors, then you'd be underperforming. And what this is doing is it's kind of melding these stock indices together. The S&P 500 now is made up of 45.8% AI stocks. And you might think, what's the big deal? Well, it means that the S&P 500 is now getting closer and closer and closer by the day to the actual NASDAQ in terms of makeup. And it presents kind of like a bit of an issue, a concentration issue, something we saw in the 1970s in the Nifty 50, something we saw in the dot-com bubble, something we saw, of course, in some of the Asian crisis periods as well. A concentrated market is always a sign of something worrying on the horizon. But of course, like anything, markets can stay maybe a little bit irrational before, of course, you can remain solvent. So is it time to short? Probably not. On top of all of that, it also is a time of complacency. We've seen particularly the bonds market show absolutely no signs of freak out since those April, May bottoms. And it's just been in a steady downward channel here in terms of the way that we're seeing risk on in this market. Nobody seems to care. And of course, that is one of those things where complacency equals a dull bull market, even in the signs of a wall of worry. One of the best markets to be in, by the way, in terms of the bull side. But of course, you need to be aware of this stuff. And don't worry, guys, if you're watching this channel or if you haven't even subscribed, make sure to hit that bell because we do track it daily to see when the bonds market freaks out. Now, is everything all bad? Well, not really. The economy and the stock market are a little bit separate. On one side, the big tech companies, the big AI companies are spending tons of money. And we know this tends to mean lots of profits are happening. Also, one of the most expensive inputs is, of course, labor. And we're seeing plenty of people, unfortunately, getting sacked across the board. And what is this happening? Well, it's happening because big tech companies overhired during 2021-22, and now they're able to fire people from certain divisions, of course, leading to more profits and leading to Wall Street basically saying, you know what, it's all green, all good on profits. You can see here the upgrades coming into this earnings season seem to be bottom up. And it's a big deal because if we do see these estimates come true, then of course, what does that do? It starts to pack into price on the markets. Do remember though, markets tend to come in with optimism, so it can be buy the rumor and sell the fact, especially if markets come in very strong. And conversely to this, if markets came in super weak to an earnings season, often it is buy the fact. So something to keep in the back of your mind when you're taking a look at everything that we're seeing right now. So guys, what does this mean? Well, we have a look here at semiconductors and we know that the market's been ballistic for them. And like we've been talking about, when we've got breakouts, such as we saw just about a month and a bit ago, you want to be on the rallies because this is basically the most important sector in the market. And when it's going up, the index is going up and pretty much everybody is all happy. But we have hit a level that we showed in the previous video, which was from 2017 late-ish area, which was a RSI kind of period that is very, very important. Now, why is this happening? Well, we're overbought. And that doesn't mean that the markets go down tomorrow or any of the other days, but it does mean that you've got to be kind of like understanding that there is some risk in markets and that maybe Wall Street might start to show their hand. And we've started to see some large transactions in the last week or so, which have been kind of unusual. We've got the 9th largest trade ever to go through semiconductors happening only 48 hours ago. We've seen several S&P 500 and NASDAQ indices showing some of their biggest trades ever. And of course, this is all ahead of this earnings season. Now, is that a point to panic? I would say no. And of course, we always let the general TA, that is the price action, actually show us the way. But in this case, we do know that, of course, earnings season is about to kick off once again. You can see here, based on this week, we've got not the biggest companies in the world, but we do have PepsiCo, and we've got, of course, Delta and other things coming through. And what this is telling us is that we basically have a point here in the markets where we're about to see the banks next week. And when we get an idea on the banks, what are they going to show? They're going to show most likely lending and debt expansion. And you might say, well, that's good. And that's true. Debt expansion is one of the greatest growers of markets. It has been for over 100 years. But at the same time, you've got to ask yourself, who's taking that debt? How levered are they? And are they in trouble? Well, we don't know that yet. But what we do know is that debt most likely has been expanding at a pretty good accelerated rate. And that people are, of course, taking more and more debt by the day to try to keep up with the rat race. That's led to one of the best gains as well on the NASDAQ as everyone piles in. Now up to 117 days, we've been moving up with no 2% decline in the NASDAQ. So it's basically just been up with almost no sell-offs, no weekly 20 moving average, no mean reversion since, of course, Liberation Day lows. And why this is important is because it does mean it could be a calm before the storm. So where does it look like the smart money is putting its money? Well, we've long argued for a couple of years now that metals look very good. And particularly this year, we started to get incredibly strong on silver, along with our gold positions. And in our private community, we got very strong on some of the precious metals recently, such as palladium and platinum, which are still potentially early days. But what this is actually happening, or what's occurring now, is we're seeing dollar debasement. So fiat debasement across the board is occurring here when you compare gold, silver, platinum, palladium, other precious metals considered sometimes currencies against some of the biggest pairs. The US dollar is actually leading the charge in terms of dollar debasement. And you can see here the euro and the yen also falling in purchasing power versus these assets. Now, is this important to note? I think it is, but I do think that the story of the failing of fiat currencies is now starting to grow everywhere. And you've always got to remember, when everyone talks about something, sometimes the market can go the opposite direction. So follow price action more than you follow your opinion. Now, when it comes to palladium, if you're following seasonality, which we often do, this is actually one of the better times for palladium, platinum, and some of those metals. And you can see here, based on Jay Keppel's post, that if you generally buy palladium around this time of year, often it can do quite well. Now, that's not a solicitation to go buy it or do anything. Do remember it's already been front loading, so it's definitely not following the standard trend over here, but it is still a very interesting point for it. And what we're seeing is metals across the board becoming some of the most interesting trades. So we've got here, of course, the palladium bottom, which you can see, very nice looking base formation. If you saw that in a stock, if you saw that in a metal like this, if you saw that in a currency pair or anything else, then you would probably quite like what you're getting towards here. It looks kind of like a Wyckoff style or accumulation base. You'll also notice that when you start to look at metals by historical averages, gold miners versus overall money supply, that they're actually breaking out, and it could still be early days for some of these metals. And that commodities are also absolutely front loading the problem that could be underneath, which is, of course, reinflation, or at least an insidious inflation that maybe we're not even seeing. Remember, we're in government shutdown right now, so we're not even going to get stats or data. We almost have no idea what's going on. And at some point, the market may start to say, well, wait a second, what's going out? Or even more shockingly, we might be coming out of a shutdown, get some data and go, whoa, it's not as good as we think. But the commodities market, certainly, whether it's oil, whether it's, of course, other commodities, precious metals, any rare earth mineral metals, anything like that, we're seeing basically just skyrocket off this year. And that's something similar to what we saw before we really realized that inflation was really knocking around the world. And a lot of you guys have been posting in the comments down below saying, Tom, inflation ain't dead, man. Things are going up. I'm seeing it firsthand. I actually just got a message today from one of my friends, and he was telling me that that particular company has literally stopped dealing in the US because the tariffs were too harsh on the imports. Now, of course, it's only a small business, but this is starting to flow through. Now, where are we? Well, we're about 6 months after, of course, the tariffs were implemented. And what this is doing is it's starting to have that ripple-on effect. So there's real damage being done here. And of course, we don't see it in the charts because Wall Street doesn't care. But at some point, that could become a problem. So just remember, these things are here. It's what we call the wall of worry. Generally, if price action jumps up above the wall of worry, you follow price, do what they are doing, not what they are saying. And of course, we watch structure. Speaking of structure, structure will be the most important thing for us to watch over the next 1 to 6 months. And as you guys know, if you've been watching the channel for a long time, we used this last time as well to really figure out that we were on a likely no recession path during 2025, but that we would likely also see a 10% plus pullback. We ended up getting 20%, which I didn't think we'd get, but we ended up getting even bigger. And this is because there are an average amount of times that these types of things happen. And you do need to be wary, kind of like we know that the NASDAQ's been going up with no 2% sell-off, that's unusual. It can occur. It has been higher before, but it's starting to get into one of those Goldilocks style scenarios. Almost everything looks perfect, and you've got to ask yourself, is really everything perfect at some point? Now, which is the most important level to watch? Well, it's going to be the daily 20 moving average on the S&P. But on top of that, it might also be the fact that we should be looking at October 20th to 27th. According to Wayne's latest data, that is the worst period of time that you can usually be in the markets based on similar structural history to where we're going from. And it's only 4 up, 16 down. Now, we could be 5 up, 16 down by the end of this year. It's been so strong. But at the same time, it's something to keep in the back of your mind. October is volatile. Often it's at the end of that particular month. Now let's jump on over to the S&P and have a look. Now we just mentioned the daily 20 moving average. What is that? It's this red line here. For anyone that hasn't got that one on your charts, you want the 20. It's well used by the industry, including all the big guys, and you often see it in their reports. Now, is this market shorting? The answer is quite simply no. It's not really shorting at this stage. The market has continued to say a series of higher highs and higher lows. And of course, until it really breaks that trend, you've got to go with the general positive gamma of the markets. In terms of the next 24 hours, here are the options, high and lows. All I really noticed over the last 24 hours was that we did end up closing at a new high, and that, of course, volatility is slightly going up. But nothing really to note here from the S&P that changes from the previous session. There are other opportunities out there, though, that I think are more interesting. Let's have a look here at the S&P in terms of positive gamma and how it's going. 6750 plus close is, of course, relatively strong. It pushes that 6800 narrative, which you see on pretty much all of these charts. And of course, if we get through 6800, it pushes that 7K narrative. So funnily enough, last year in October and September, the prediction that I had was 6850 by October. And I cannot believe it's getting so close, especially when we went down 20. This is pretty wild. And that just shows you how important structure is, because that was actually based on a structural call. And it's very interesting to see that. So maybe what I'll do is I'll whip out those slides and show you guys that in another video if you're interested. Let's have a look here at Tesla. What is Tesla doing? 438. So you can see here that spot price is basically between those two zones. 450 is the call wall, 430 is the put wall to 420. So it's stuck in the middle of nowhere. And we've talked about NVIDIA. We thought it was going towards 200. I guess I can't change that opinion at this stage. The way it's looking, it still looks strong, even in the face of adversity, which is, of course, the AMD OpenAI deal. It's just it's a fairyland, guys. We're in the fairyland. It's all good, all green, all good. And, of course, there are a lot of people claiming the multiples should be higher. So, of course, NVIDIA pushing towards that 200 target, at least based on the options. When we go over to, of course, Bitcoin, it's still above 70. 73 seems to be a bit of a marker that's coming up. But we do know that 70 on IBIT is huge when you start looking at longer date expirations. Here's the end of October. Here's the OPEX, which is in November. And you can see here 70 is a big deal. So if we do hold above 70, we keep holding above it. That's going to be really strong for maybe an October or a November. But at this stage, it's kind of dealing with that as a bit of a resistance. When it comes to gold, it just keeps going. This thing it's ballistic. I mean, are we going to 380? Are we going to 380, guys? Look at this, 380, 380. You know, it's coming up now on the next call wall. We're above 372. We're smashing 4,000 plus an ounce. We're absolutely going. That would basically push us to a 4,200. You know, this is a pretty wild thing, but I still don't have signs of it weakening. You know, I do know that it will be volatile in the future. I feel that. And, you know, feelings are bad, by the way. You don't want to have that type of bias. But what you do know is that statistically, when we get the RSI as high as it is now in the monthly, vol is somewhere. The thing is, though, it could go up 20%, you know, before it loses that 10. And that is always the argument, of course, each way. For me, it's basically follow the trend. We're in the box between 4,000 and 4,200. And this is where I expect vol to start coming back in at some point. Now let's have a look here at the bonds market. No causes for concern on bonds. They've been like just chilling all year since April. And there's just nothing there. We cannot see any risk. And I'm looking. I know you guys are as well. You're sending me stuff every day, which I do appreciate. You can send me some DMs if you wish to on X. If you do see stuff, follow us on X, by the way, because I'm always interested in what you guys are finding out there. Maybe you can help us all in the community. But at the same time, you know, it also is meaning that there are different opportunities. We've seen rotation back in August, of course, to different things. And it's really been a metal commodity side. The one commodity that hasn't gone, though, has been oil. Now, I do like this particular candle here. I think the base is interesting for early people. And of course, oil services, while chilling still to me, looks pretty good on the charts, break up and those types of things. But maybe the standout of the last 24 hours was this one. Wow. I woke up and I went, what? I had to put on some glasses because I couldn't see the screen because I was like getting blinded by the green candle. That was an exceptionally big day. You can see here that it actually at one point was over 10% up for palladium. And you might say, well, that's probably it. Well, you've got to remember palladium has been in a base structure for a while. We've looked at this in our private community for a while. And you might say, well, that might be it. Well, wait a second. Palladium is still really cheap based on where it's been in the past. Now, I'm not saying this is the greatest metal in the world. It isn't. It's also approaching its first kind of thing. And I notice that a lot of people are talking about it now. But both it and platinum have been coming off big bases. And in fact, platinum now has the best percentage of the year in terms of gains. So if you actually just look down here and you look at this, it's up 84%. That's stonking. That's a stonk. It's a stonk in the world of metals, guys. So yeah, we've got some pretty big moves here. And I guess all I really wanted to bring it up for is just to say there's always another one. While everyone's sitting there going, oh, gold, you know, dancing around, wearing gold chains or whatever, Cubans. At the same time, you guys could see here, by the way, I'm in chains, by the way. They're not big in Australia, but I know they're big. I think is somewhere in maybe Miami. I think I saw a few people I met up in Miami wearing the old Cubans. So you can see here, platinum, others. This is where we're getting this other abundance opportunity. So there are always new ones, and I think I really want to keep reiterating that. A lot of you guys say it's helpful. It really is. The stock market, the markets in general, they are about opportunity, always something new. You miss something, no FOMO. No FOMO. We never FOMO. That is a mistake. You will lose. People in the comments, let other people know when you've FOMO'd how it goes, because it might seem good for a couple of days, but you are not treating trading and investing like a business. It is a business, guys. It is tough. It's tough out there. Everyone else wants your money, of course. So at the same time, you've got to put yourself in the best positions you can with the best risk rewards that you can. Let's have a look here at healthcare, another sector that just came through. Now, I did have a chart, which I think I glossed over before, but basically what it showed was that healthcare insiders, they're continuing to buy, and they're buying at fast rates. And a lot of people say they're not, Tom, but, well, it seems like they are. So they're buying as far as I'm concerned, and that is an interesting thing for liquidity. Obviously, the price action shows that. And you can also see here that even though dollar debasement is clearly occurring and people are super negative on it, the dollar actually is bucking the trend of short. And that's because I think it's in the press, therefore it's in the price. The most crowded short became stabilization, and that's what tends to happen. Remember, gold is now becoming the most crowded long. Again, which makes me sad because that means at some point it's going to have to consolidate. But clearly, this is what happens. You always get those kind of blow-offs. Everyone happens to get on it. And remember, if someone in the elevator is talking about the investment that you love, you got to be worried. That is a concern. For now, though, dollar seems to be breaking up, and I would be looking for 99.80 in the future. Let's see if we can get there. Now, gold, wow, I'm looking for vol. We know that these trends usually end in large volatility. So we're looking for volatility. Can't see it yet, but certainly it's moving up to that 4,000, 4,200 zone. And silver just keeps plucking away with a new higher high every day, it seems. So this is moving up to those all-time highs. Will it hit one first? I like to think it usually would consolidate around here, but of course, our eventual target for silver is probably around $80 an ounce. Tesla, a lot of you guys want me not to gloss over this one, but I don't know what to tell you. It is stuck in a range, and it is options-based. So it's 430, 420 on the lows and 450 plus on the highs. And I guess you want a high here now, which will probably be about 455. You get that, probably moving to 500. You get below here, might get a little nasty. So yeah, certainly one to watch at the moment in the upwards trend. Semiconductors bucked the trend of the sell. Now, that was the biggest vol. This is volatility. You can see here, it's starting to come into the most important markets. 2.88%, then goes back up pretty much the same thing. So this is a fairly large move, something, of course, we're watching very closely, because you can see here that NVIDIA is also rallying. So NVIDIA putting in a good day yesterday, I thought, as well. So that's kind of pointing towards that 200 target that we've got on at the moment, maybe even higher if we keep going ballistic. And there's clearly so many different things going on. But generally speaking, it is bullish. There's vol, though, in semiconductors, because otherwise we wouldn't see those big moves. And obviously, we continue to look at mags because, yes, it's coiling. Yes, the trend is up. So you got to think the trend is up. But what happens if we lose this level? All of a sudden, the key sector, maybe even semiconductors at the same time, is starting to lose some of that shine. And that's going to be a bit of an issue. NASDAQ popped in a new high, so no changes there. The Russell 2K popped in close to a new high. So again, daily 20 following that quite closely. And with Bitcoin, it is still got a great weekly close on it. So although it's struggling with these all-time high levels because I think options are floating all over it, remember, if we get through here, then we could start to pump. And to me, pullback's probably met by bull demand at this stage. Alt market's looking more interesting. It's going to follow similar to other cycles. We'll talk about that soon on the show and go into a deep dive of it. But remember, if alts go, it's not for long. So it's usually a pretty short and sharp kind of move as everyone goes hyperbolic. And that's another thing. I'm looking for tokenization. And I'm looking for the cryptoverse to show us a bubble, like really going euphoric. And we just haven't seen it yet. I know you think you have, but we've seen enough of these to know how they usually go. And it's generally someone walking around with a picture of a dog on their shirt and a dog cap. And then they're like, and then they got like, some diamond teeth or something. And when that happens, then you're at the high. But we need to see dog cap, dog shirt, diamond teeth. And until we get that, guys, I don't know if we're actually at the top. All right. So if you enjoyed today's video, remember to subscribe. Hopefully soon we get some economic data, but we're probably not going to see that just yet. And if you want to find out more about how we do replicatable things such as China, such as, of course, what we've done on the metals and gold, particularly years ago, and even stocks, semiconductors, how we track all of those things and find the right sectors for the right times. Check out our advanced course, Day Trading Masterclass will get you pinpoint accuracy as well. It's really awesome stuff. And of course, follow us over on X. I really appreciate you guys sharing stuff as well with me. It's always good for the show, helps me find things that maybe I don't even see. And if you appreciate the content, give it a like, subscribe. We'll see you in the next one. Guys, it is a market of abundance. There are plenty of opportunities out there. And if I was to summarize right now, it seems expensive, it seems crazy, but at the same time, what are the flows doing? They're still up. But I would caution one thing. Why is retail so horrendously bullish? Like, we have got so many. And why I say it's horrendous is because I know that retail is levering. So you got to be careful, guys, sometimes out there. And we've just hit an all-time record. Bye for now.